Hello, Emily.
Good morning, Dan.
What are we talking about today?
Reverse mortgages, the upcoming election, and credit card points.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, reverse mortgages, the election, and credit card points. It's a fun variety, so start us off. What do we want to talk about first?
Well, I'm going to jump into the reverse mortgages because that's something that people ask about a lot and we advise on a lot. But it seems to me that the common perception of them is overall negative when we first bring them up to people. And I know the regulations and stuff over the years has changed quite a bit from what they used to be to what they are now. So I thought maybe we talk a little bit about the changes, first of all, to give people some context.
Okay. Well, for people who are listening who know nothing about reverse mortgages, let's just explain that first. So, reverse mortgages come in two flavors. One in which you essentially have a home equity line of credit, like a HELOC, except that you do not have to make payments on it or pay it back so long as you maintain residence in the home. This is good for people who want to stop their mortgage payment as they enter retirement, or people who need a lump sum of cash to pay off other debts, or who want to do certain advanced planning strategies like paying the taxes for a Roth conversion with tax free borrowed money. So there's a number of potential applications there. The other version is more like an annuity, essentially, in which you will receive a monthly check borrowing from the equity in your home until you either sell the home, pass away, or move out of the home. But all these are powerful tools for seniors to potentially tap onto one of their biggest assets, which is the equity in their home.
Okay, so who owns the home if you take out a reverse mortgage? Is that you retain ownership or they do?
Well, you still own the home. The home itself is effectively yours. You've just taken on a new mortgage, and it's just going in a reversed direction. Instead of making payments to increase your equity in the home and reduce your liabilities, you are receiving payments on the home and accruing a liability. But it's always your home. If you decide you suddenly don't want this reverse mortgage, you could potentially take out a conventional mortgage and pay it off and then start paying it down. If you had the home equity collateralized mortgage or the HECM, which is the HELOC version of the mortgage, you could just never borrow the money and just maintain it as a line of credit. So there's a whole bunch of potential options there, but you're always the owner of the home. And even when you pass away and leave the home behind to your family, they too own the home. They just need to either refinance to pay off the reverse mortgage liability, or they need to sell the home to go ahead and pay it off and take whatever equity is left.
Okay, so that's why, regardless, you have to pay taxes and have insurance and everything. It's still yours no matter what.
Yeah, and it's your property, and I think the place where a lot of the bad reputation of reverse mortgages comes around shows up in two places. One, there was a period early in the existence of the product where there was less regulation, and so some people did get into products that were a little bit slimier, a little bit skeevier, and were taking advantage or doing harsh things to them. Today, if you want to take out a reverse mortgage, you have to complete a mandatory class in order to actually start the process of applying for the reverse mortgage. And that class gives you a healthy bit of education about the parameters and assumptions and so on. And then from the standpoint then of, whether it's a good or bad thing, realistically, most of the complaints I hear about for reverse mortgages today, I hate to say it, but they're just sort of entitled complaints. They're people who, spent all the equity in their home and then they decide they want to relocate and now they're mad that there's no equity in their home. Or they are kids who are mad that their parents spent all the equity in their home or a chunk of the equity in the home and their inheritance is smaller. It's an asset. In the same way that your bank account is an asset, in the same way that your car is an asset, in the same way that your 401k is an asset. And if you want to financialize it, right, if you want to convert the invisible equity and value of your tangible real estate into spendable money, that requires a financial product, right? Whether it's a HELOC or a reverse mortgage or just borrowing money and using your home as collateral in some other way, shape, or form. And with that, if we borrow money, to no one's surprise, you're going to have to pay it back at some point.
Sure. But I know a lot of people that I've spoken to anyway, it's a very emotional decision to them. This is the house we raised our kids in, or I've stayed here forever, or, I really worked for this home. And yet they need to maybe take out a reverse mortgage. That is what makes the most sense for them. How do you go about separating the emotions of like, this is my home versus this is just an asset?
Well, I think first and foremost, we have to make a decision about whether this is an efficiency decision or whether this is a necessity decision. So, if it's a potential efficiency decision, you've got an adequate 401k or pension or savings, you don't need the reverse mortgage, but you're thinking about a reverse mortgage. I do think some of those factors matter, right? Is this the home you raised your kids in? Is this a family property that you want to make sure stays in the family or passes down through the generations? Those are important considerations. Leaving a tangible real estate asset to your family can be a very valuable legacy item. And so, if those are your priorities, a reverse mortgage probably doesn't make sense. But if you are in just, let's say a home you relocated to, right? You raised your kids, they all grew up, they moved out, and you decided I'm going to move to Florida, and live there in my senior years. Then in those particular circumstances, it's just a box you live in, right? It's a very emotionally important box. It's a very literally close to home box, as it were. But at the end of the day, it's just an asset, and to go ahead and utilize the equity in that asset can be a very valuable tool. On the other side, if you're in the necessity camp where you have not saved adequately for retirement or you've been through financial hardship and you need to make financial improvements in your situation in order to survive retirement or avoid becoming a burden on your family, a reverse mortgage is just a question about when. Because either you will live in your home until you run out of all your other sources of income and you will be forced to sell your home or be forced to take out a reverse mortgage to stay in your home, or you can utilize the equity in your home to preserve some of your more liquid assets like your 401k, IRA, and so on. And again, you can stay in the home. It doesn't matter how much of a liability it accrues potentially, right? You're able to stay in the home until you either die, decide to move out, or need to move into some sort of assisted living situation, at which time your home no longer has a direct where you live relevance. And again, you've been able to utilize the equity more efficiently. So, there's obviously a lot of emotional baggage that comes with it, but at the end of the day, it is an asset. It just, that simply is what it is. If you've put a lot of emotional weight on the importance of that specific home, then that's fine and fair, and that's your decision to make. But at the end of the day, it is an asset, and it is a very valuable asset.
I suppose so. I have a question. You mentioned, you until they stay in the home, they can stay into the end. But if you're living in that house, you have a reverse mortgage on it, and then say after a few years, you're like, okay, I do need to move to a nursing home. How does that work? Do they pay you out a lump sum for the remainder of the value of the house? Or how do you transition from, they've only paid me a portion of what my home is worth?
Sure. So let's say it's that situation. If you are single, you are pretty much just going to be selling the house. You could technically take out a new mortgage on it, make payments, but it sounds like in this situation, that's really not a practical decision. So functionally, at that point, you are going to sell the home. You're going to pay off the reverse mortgage liability. You're going to get to keep the difference, and then use that to pay for your care or your new living situation. If you have a spouse who's living in the home, it becomes a question of whether the reverse mortgage was taken out on your life individually or against both of your lives. If one of you is still living in the home, then your partner can still potentially live in the home and continue to utilize the reverse mortgage. This is where I sometimes see a bit of a mismatch between how some attorneys will recommend using reverse mortgages versus how financial planners will recommend using reverse mortgages. I often see attorneys, particularly estate attorneys with elderly clients, advising the healthier spouse to take out a reverse mortgage and stay in their home to pay for the care of their other spouse who is now transitioning into assisted living. And that's not a bad strategy, to be clear, but that often then creates a situation where, as a financial planner, we would have probably advised taking out the reverse mortgage sooner to free up the equity in the property and get better utilization out of it, versus suddenly kind of drawing these big lump sums to pay for large care bills. Because alternatively, we could have potentially gifted the property or left it to other family members or placed it in a trust much earlier on and utilized some of the equity in the property while we were still living there, and then ultimately been able to potentially pass on the full value of the asset versus suddenly encumbering it at the end of our lives to pay for care that might have been covered under Medicaid had we done proper planning.
Sure. Well, another instance where planning is important. I have a quick question about the value when they're deciding, is it based on the value of the home at the time you take out the reverse mortgage, just fair market value that it would sell for?
It is based on that. There are some assumptions around its expected appreciation. That's part of what makes it work, particularly if the assumptions don't hold true and the person lives a lot longer than they're expected to and they live in the home a lot longer than they're expected to. The appreciation is part of the calculus that helps preserve the value of the equity and helps make the overall economics work on behalf of the lender. But it is based on its current fair market value at the time that you take it out, simply because we can hypothesize what it's going to be worth in the future, and the bank is certainly taking that into account when it lends you the money. But we can't just say like, well, it's going to be worth twice as much 10 years from now, so you should lend me twice as much. That just doesn't fit the financial model.
Right. And so people can expect to be paid back over time 100% of that value of the house at the time?
There is typically a buffer between the full fair market value and the actual amount that can be lent on. We typically see about a 2/3 approximation for the value of the home, simply because there is going to be interest on this loan, right? You're borrowing money, it's going to accrue interest. And so if they try to lend you 100% of the value of the home up front, then they are entirely relying on appreciation of the home to make up for the potential interest. So there is essentially 1/3 of the value of the home that's going to be kept in reserve as far as what they're willing to lend you to account for the accrual of interest over time.
Sounds like a pretty powerful tool, though, as you're nearing the end of life and trying to plan.
Yeah, I mean, you can live effectively rent free in your home minus property taxes and maintenance and spend 2/3 of its value throughout the course of your retirement and enjoy all the benefits of the home, living in it essentially indefinitely, so long as your health and circumstances permit it. It's not a bad deal. Again, it's not for everybody. It's not the right solution. It's not a silver bullet for every single retirement income problem, but it's a very powerful tool that unfortunately has a very bad reputation because of the history, but also, again, because of some of those have your cake and eat it too feelings people have about it.
Yeah, it's always an emotionally charged decision, I guess.
No, I mean, I'll tell you, I recently just pointed out in a Twitter thread that a lot of people who are complaining about reverse mortgages in the cake and eat it too way were being a little bit entitled and not really thinking through the potential value of the thing. And somebody came out and called me a parasite for being in support of them, despite the fact that we don't sell reverse mortgages and we're not in the reverse mortgage business. So I do agree. There is quite a bit of emotional baggage behind it.
Yeah, you're also kind of an instigator on Twitter, though.
I don't start fights. I merely correct them.
All right, on that note, let's turn to a different topic. I want to talk about the election. Obviously, as far as of today that we're recording this, the presidential debate was last night. I know we both watched that. And again, there's a lot of emotions around the election and this and that. And personal politics aside, I won't get into that. But pretty much everyone I talk to is like, well, this is going to change the markets and it's going to have a huge impact. And, depending on who wins the election. But every time I talk to you, you take a much longer term approach to looking at it. Do you want to talk a little bit more about that?
Sure. Simply put, who wins the presidential election doesn't matter.
Why?
I mean, functionally, markets have way more things going on in them than simply who is in the presidency at any given time in any particular country. Some presidencies in some countries matter more than others in an economic sense. That can't be ignored. Economic policy, fiscal policy, many things can certainly be set from the Oval Office or can be changed and can cause positive or negative impacts in the market, but the market is a consistently adapting mechanism and organism. And so from that standpoint, even if you have, let's say, a very pro-market president, that doesn't mean that the market is going to have a very pro-market environment to operate in for a multitude of reasons. Maybe we go through a recession despite the pro-market nature of policy, and in vice versa, just because somebody is sort of bearish on the market or is hawkish on economic policy and locks things down and puts on tariffs and so on, that could hurt the market. But if there's enough enthusiasm in the marketplace, enough innovation in the marketplace, then it's going to overcome that regardless. There have been historic periods where things like stagflation in the 70s, where the market really did flatten out for quite a while because of a multitude of economic factors. But who wins the presidency, who's in the Oval Office, is just one variable out of countless variables that affects the overall marketplace.
So that would explain why this morning in the news, there's obviously several articles about the debate, but the headlines are talking about the CPI and anticipated rate cuts and not necessarily the debate at the top of the page.
Well, and the funny thing about that is, the debate was depressing, but ultimately, from the standpoint of what matters to the marketplace, something like CPI is much more influential because inflation is a material impact not only on the return on investment for all financial assets, but also, in this particular month of September 2024, right? It's a really important leading indicator to what the Fed is going to do next week regarding whether they're going to cut rates by 1/4% or 0.5%. So that's just one example where you might think, oh, presidential debate, that'd be the most important item of the week. But as far as the market's concerned, the CPI report this morning is way more important.
Yeah. Well, how do you go about, I mean, you can say it in a factual way as you just did, but I've talked to so many people that are still very anxious about the election. And regardless of who wins, they're like, well, I don't want to be in the markets. I'm thinking about pulling out. I want to be more conservative. And I've had a hard time. I've talked to several people and they're like, I'm nervous and I don't want to be involved. How do you soothe those fears?
I mean, at the end of the day, I'll give you two sort of thoughts around this, and this is a variation on what I would say to any client or any person who's expressing the anxieties. One is a back office sort of thing; it's a thing that I know, having been in multiple conversations, and the other thing is just a direct, individually facing thing. So here's sort of the back office behind the curtain perspective. For every client that comes to me and says, I am terrified that Donald Trump is going to win, or I am terrified that Joe Biden is going to win, or I'm terrified Kamala Harris is going to win, right? I'm a devout Republican, I'm a devout Democrat, and I'm really scared of the other side. I promise you, whatever version of that argument you're on, I have then heard somebody on the opposite side of the argument express the exact same concerns going the other way. So, anxiety around the marketplace and economic events and so on is sort of natural, right? We are really excited when our guy or our gal wins, and we're very concerned about what if the other person wins. And there's a huge amount of data that shows that economic sentiment among Republicans and among Democrats essentially flip flops like a light switch based on the election. I mean, it's truly fascinating, right? Right now, something like 70% of Democrats will say the economy is good, and something like 30% of Republicans will say it's good. But if you went back, 4 years prior to the election, it was something like 70% of Republicans said the economy was good, and 30% of Democrats said it was good. And as soon as the election of Joe Biden happened, that switched almost instantaneously. And that's really just a result of the media and the material we consume. We are easily swayed by the messaging around us, despite how independently we might think we operate. So it's just something to be mindful of. Is right now every conservative person or kind of heavily conservative person I know is really concerned about a recession and a bad economy, and every Democrat I know is sort of shrugging their shoulders and saying, frankly, everything seems fine to me. And the data, in fairness, the data does suggest that everything is going pretty well right now, but there's plenty of leading indicators and lagging indicators and so on. All this to say, it doesn't really matter what your political alignment is in the grand scheme of things. You are worried about one thing, and the opposite side is worried about the exact same thing, just going the other way. And that should tell you something. From a direct how to assuage your fears and concerns standpoint, really the question is, if you act on your fears, if you sell all your investments and go to cash, what then? So let's say you sell everything today, you listen to this podcast and you go, all right, I'm out, I'm cashing out. Great. And then what's the plan? We're going to wait until the election. And then if your guy or your gal wins, you're going to get back in. Well, okay, you're going to miss out on 2 months of market activity that could have been good, bad, or otherwise. We don't know. In such a short term period, it could be all over the place. Let's say your guy loses or your gal loses. Okay, what's your plan? You're going to you're going to sit on cash for 4 years. Well, in a 4 year time period, the market goes up about 4 out of 5 times in that short of a period. And so from that standpoint, if you got out because you were worried about things going down and it goes up even, let's say 20 or 30%, and maybe it even goes through then a 10% downturn during that time period, great. It went up by 20%. So it went up from, let's say 100 to 120, and then it goes down by 10. So it goes down by 12. You're still behind by 18%, right? If it goes up by 30, now you're behind by 13%. All of this to just say, what is your strategy here? You're hoping that an apocalypse happens, or you're concerned that an apocalypse is going to happen. And then you're going to have the confidence to jump into the marketplace if that apocalypse happens. And the sad reality is what most people do is they sell, they get out, things go down. They say, oh, it's terrible, I'm not getting in now. Things start to recover. They say, oh, I don't trust it. It hits break even with where they got out. And unless they're really quick on the gun to jump right back in, now they're behind again, even if there was a big downturn. And it's hilarious as a financial planner because there's so many consumption decisions and investment decisions that people say that they're just waiting for the next downturn, right? I'll buy a house the next time the market turns. I'll invest in the market the next time a downturn happens. I'll do a financial plan the next time the bad thing happens, and then the bad thing comes and goes, and they don't take any action because it turns out we are easily influenced by what's happening to us right now. And that long-term strategy of I'm going to get out and get back in based on circumstances is just very difficult to execute on a emotional level. So as a financial planner, right, and we're sort of criticized for this, but it actually happens to be a very good thing that we do. Our basic disposition is there's never a bad time to be in the market. The market's up and all-time highs, great, get in the market. The market's down and the market's still falling, great, just get in. Right? The point here is you just need to get into the marketplace, and as long as you stay in it long term, you'll be fine. It's just a matter of being cognizant that that really relies on the execution of the plan to get in and stay in long term. But if you plan to jump in and jump out, I hate to break it to you, there are thousands of people with PhDs and CFAs and Masters of Finance whose full-time job is to time this sort of thing, right? To follow the market and the economy and jump in and jump out. And by and large, they all suck at it. And I hate to break it to you, but if you're a gym teacher, if you're a banker, if you're even a financial professional, by and large, timing the market is nigh impossible. We're good at it in hindsight. We can say, oh, well, of course the downturn was going to happen. But in practice, to look into the future and have a functioning crystal ball is a fool's errand. Some people happen to guess right, and then they trick themselves into thinking that they knew it all along, and then they'll just get it wrong the next time and wipe out any possible value they had to guessing. So get in, stay in, and if you're worried about the election, stop watching the news.
I guess it kind of highlights the importance. You've always told me working here that, a financial planner, it makes sense to have your own financial planner, not because you don't know the facts or the logic, but it helps remove the emotion of someone else giving you advice because we're all prone to it and we all kind of want to react to it, even if it's best not to.
Sure. And I mean, if it's any comfort to anybody here, right, on a daily basis, we will make or potentially lose hundreds of thousands or millions of dollars for our clients every day. Every time I log on to the market or I log onto our accounts and can see all of our client assets and so on, I'm looking at good days, gains of again hundreds of thousands or millions of dollars, and on bad days I'm looking at losses of hundreds of thousands or millions of dollars. That's emotionally stressing. Let me tell you, that is not fun. But I promise, if I can see the accounts we're managing lose $1.5 million in one day, you can stand to see your balance go down by $5,000. And it's all relative. It's all to scale and all to size. But at the end of the day, I promise any amount of stress you might be feeling about the markets or seeing your account go up or down or sideways is all relative. It's your money. I understand your attachment to it. My money's in the market too. I'm attached to it. But at the end of the day, you have to get in and stay the course. That is the only strategy that has a long-term track record of success. Everything else is just down to luck.
I almost wish we were ending on that note because it sounds really good. It's a good end piece. But I have a third point that I want to talk about, so we won't.
All right. Come at me with the third point then.
All right. The third and final thing. This one's a little bit more fun, I think, a lot more uplifting. But credit card points, I hear a lot of people talking about kind of chasing them, comparing them, this and that. Should I do cashback, travel rewards, all of these things? At the end of the day, is it worth really deep diving into that? Is there a lot of value there?
It can be, and I want to bifurcate credit card perks with credit card rewards, right? Rewards, we're talking about cash back or miles or points that can then be redeemed for miles or cash or gift cards or other things. I think the number one thing to think about is functionally, I would advise that almost anybody do the majority of their consumer spending through a credit card, with the caveat being that they need to have it set up on an auto pay that pays it off every month before any interest accrues, so that there is never any actual cost to using the card. Now, there are some cards that have membership fees, $100 a year, $500 a year, but you get, club passes to the United Lounge, or you get early access to Taylor Swift tickets or something like that. There's a whole bunch of things like that. For me, I generally recommend really just one of two core considerations in the utilization of rewards cards. Number one, if there's a cashback component to it or a miles component to it, are you going to get enough cash back or miles back to cover the fee? So if the fee is, let's say, $100, are you going to then spend, let's say, $10,000 on this card over the course of the year if it's a 1% cashback card to get your $100 back? And if that's the case, okay, great, that's fine. Or if it's miles, are you going to get the equivalent value in miles back to cover the fee? And if not, then that needs to be accounted for. But then, as far as whether you do miles versus points versus cash back, my biggest suggestion there is to utilize a version of a reward that ultimately incentivizes the thing that's most important to you. So, I'll give you an example. I utilize a miles card. I utilize a miles card for business expenses, for personal expenses. And the reason for that is because I want to be forced to utilize that benefit for travel. I don't want it to just be cash back. I have plenty of money. The business has plenty of money. We continue to make plenty of money. And so cash is just cash. It just becomes sort of fungible and sucked back in. And even though that could be a couple $1,000s a year that we're getting back between the business and personal expenditures, it's much more important to me to encourage the acquisition of an asset, in this case, airline miles, that can really only be used in one way, which is to travel, because that's a quality of life thing that I know I'm easily inclined to not spend money on. But if I have miles and I can only use them for miles, then that's a good use for it. In turn, let's say you're a lower income individual or you are trying to save up for an objective. Cashback might make a lot more sense for you because then it's just going to help subsidize or discount your consumption in a way that makes it easier to save or accrue cash. Now, there are some behavioral finance elements here where people will overspend on credit cards. So I return to the core piece here is you should not be using a credit card to fund things you can't actually afford. You should not be spending more than your paycheck could afford paycheck to paycheck. But it is useful from the standpoint of accruing value in order to enable certain goals or objectives in your life. That's really where I look at it. There are plenty of other tertiary perks like car insurance, travel insurance, little reimbursement things that pop up here or there. There's better consumer protection for credit card spending than there is for debit card spending, so that's another value to it. But ultimately, I look at all credit card points and rewards and so on and ask, great, you should use one of those because otherwise you're just letting them keep the money. But past that point of consideration, what is it supposed to help you accomplish? That's what we should be focusing on.
Okay. Does it make sense to plan ahead? I was talking to someone here at work the other day, and he was like, well, if you're going to go on a trip next year, you should sign up for this card that year because then, they get a certain amount of miles when you sign on and this and that. And getting that specific with trying to get points and rewards, is that ever worth it if you're really being nitpicky about it? Or think bigger, think overall, and don't do that?
There are certainly points arbitrages. There's whole websites and travel blogs, whatnot, dedicated to, if you take out this card and use it for this, and you take out that card and use it for that, and there's a special promo on this one, and so on and so forth. And if you line up all the planets correctly, you'll end up with enough to take like a first class Emirates flight around the world, and Emirates has the best first class lounges and blah, blah, blah. If you want to do travel hacking, sure. I mean, there's definitely potentially some significant value in it if you go about it and do the research right and stack your consumption and rewards and sign up bonuses and so on correctly. However, be cautious about ruining your credit, number one, because you shouldn't just be taking out a ton of cards all at once. Number two, be cautious about the annual fees or the potential commitments you have in those cards because your benefits could be wiped out by the ongoing obligations of those cards very easily. And then number three, as you consider how you're going to go about that particular experience, bear in mind that you might invest an enormous amount of time into this and that on some level, to qualify for certain perks or rewards or promotions, you might then overspend in such a manner that leads you to erase any of the potential benefits to it. So between the actual financial cost and the time and energy costs, you need to have a very deliberate, specific strategy you're executing there, and you have to kind of apply a lot of discipline, or fundamentally, you might find yourself doing yourself more harm than good, despite the rewards you're accruing.
Yeah, there's someone in my personal life I know gets very excited about the like credit card offers you get in the mail. Sign up for this and you get these miles or this bonus, and it's like I always get a little bit worried about that she's so excited about them. Not that they can't be good deals, but she's interested.
Well, and as sort of the old expression goes, right, the house always wins. So if they're offering you a free $200 if you sign up, or 50,000 miles if you sign up, and so on, they've done the math, and right, and maybe you're gonna win, maybe you're gonna work it out and not actually overcommit or lose in that deal. But in the aggregate, the credit card companies, the airlines, the banks, whoever's offering this, has done the math and knows that in the aggregate they're going to make money by offering this to you. So sometimes there are arbitrages to take advantage of, but just keep in mind that they made the offer in the first place and they're expecting to benefit from it.
That's true. Are there any ways online to compare? I mean, travel blogs and stuff aside, but I know there's calculators online that will compare cards for you and the points and kind of try to average it all out. Are any of those actually useful, or should you really do the specific research on each card and each offer yourself?
I think they're a good starting point because they do help you do some of those base comparisons. I think the thing to keep in mind is that they are only so accurate, right? There's changes in the special offers and promos and things like that all the time. And so it can be very easy to run a calculator and be like, oh, I should get the super duper triple deluxe card from this bank or that place. And that data may not be accurate from the calculator. So you wanted to use it maybe as a starting place to do some research, but then you should still be line by line, really carefully checking out the terms and conditions, what the actual requirements are for getting the sign-on rewards, or 2.5% cash back, or kind of whatever the special terms and conditions actually are.
All right, I'll keep that in mind as I try to plan all my future vacations on credit card points.
All right. Well, you have had a little bit of time away from the podcast, and you are a newly minted associate wealth planner. So, what has been the big learning point over the last couple of weeks?
I don't know. I've been doing a lot of talking to new people as I was looking forward to, so that's good. And it intrigues me what kind of questions everyone has. I would say there's such a variety to it. I mean, there is the base pattern. Certain people ask you the same things over and over, just, out of curiosity and a basic level of knowledge. But everybody's situation is so specific. I'm still surprised by the questions I'm getting from people that I wouldn't expect, I think.
I think something that's hard to wrap your head around is if you've taken a finance class, you probably already know more than 9 out of 10 people in the US population. By the time you get to something like a CFP certification, you know more than 99.99% of the US population in terms of personal finance. And in the gradients between just taking one class and getting all the way to a CFP certification, you are moving the decimal place pretty rapidly. That's not to say anything ill or mean or harsh about anybody in the general population. Financial literacy is simply a very low thing in the United States, and consequently, people are going to have a lot of questions. And frankly, a lot of people have the same questions. Part of why we have the podcast here is just to discuss the very common things we run into or see all the time in personal finance. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.